Hi, I'm Dan O'Brien, the Senior Futures Educator at Trading Advantage. Before you ever start trading, even on a simulator, I believe it's crucial to understand all the components of the charts and indicators you will be watching. This video will explain Trading Advantage's proprietary algorithm chart. This cutting-edge tool is similar to what high-frequency traders and other professionals like pension and mutual fund managers often use. By employing an algorithmic trading strategy, you allow the computer to make certain qualitative and quantitative decisions about the market. While I teach that a real person must learn the techniques and make the actual trading decisions, the algo chart can give you an excellent technological assist. For those of you who have traded before, this may be a little redundant. The numbers at the bottom of the chart show time horizontally, while vertically along the right side of the chart it displays the price. The current price of the E-mini will always be highlighted in pink. Every vertical bar shows the price range for a specific number of trades. On this chart, each bar represents 610 total trades in that specific price range. The bars are colored red and blue. Red vertical bars indicate a downtrend, while the blue vertical bars indicate an uptrend. The colored bars are derived by Trading Advantage proprietary algorithm. The Donchian channel is a calculation of the highest high and the lowest low over a specific period of time. On this chart, it is set to 20 price bars. It is always shown by the white horizontal bands. The upper white band represents the high of the 20 bar range, while the bottom white band shows the low of the 20 bar range. The Hull moving average, shown by this yellow line, is an indicator to identify the prevailing market trend. Unlike a simple weighted moving average, which you may be familiar with, the Hull moving average gives less of a lagging effect, so it can be a much better indicator of the market's trend. The green mean line represents the average traded price, or the middle of the Donchian channel. For our educational purposes, price reverting back to the mean can be a trigger for many of our signals. We teach that with every trade you take, you need to immediately place a protective stop order. Trading Advantage has a useful tool to help you place your stop order. These horizontal blue lines and red lines on the chart show where the signal used to place your stop loss order should be. They also show you where to trail your stop loss order when the market moves in your direction. The blue horizontal line will be below the market and should be used as a sell stop, meaning after you place an order to go long, you would place a sell stop order at this level to exit the trade. The red horizontal lines will be above the market and should be used to place your buy stop order. This means that after you place an order to go short, you place a buy stop order at this level to exit the trade. These protective stop loss orders help to get you out of the market with a relatively small loss when the market goes in the wrong direction. These bars will always move in the direction of the market, and that means if you go long and the market moves higher, the protective sell stop will also move incrementally higher. On the flip side, if you go short and the market moves lower, the protective buy stop will move incrementally lower.
Hi, I'm Patrick Aslan, the Senior Market Profile Educator at Trading Advantage. I want to introduce you to the basics of market profile. I incorporate market profile into every aspect of my trading and the way that I teach my students. Market profile is the study of price and volume over time. It is a clear visual representation that shows development of price vertically and volume horizontally. I believe it's a great way to measure volume in real time to determine the market's true trend. By seeing the market in this context, you will learn not to place random luck trades. Market profile can really give you a huge advantage. So let's get started with the basics so you can understand the components of the market profile chart. Even though the E-mini trades almost 24 hours a day, in the level 2 room, the charts correspond to the 6 hours and 45 minutes of the pit session. The pit session runs from 8:30 a.m. to 3:15 p.m. Central Standard Time. The time price opportunity, or TPO, is a 30-minute time period during the pit session that is given a specific letter of the alphabet in order to chart the market. The letters will always be in sequence and will always be the same every day. So B will always represent 8:30 to 9 a.m. Central Standard Time. C will represent 9 a.m. to 9:30 Central Standard Time, and so on. The only exception is the P as in Paul time period. It represents the last 15 minutes of the trading session, from 3 o'clock to 3:15 Central Standard Time. You can see on the chart the pit session opens in the B period. This is the first 30 minutes of the trading day. The letters correspond vertically to the price where the market trades. When the next 30-minute period of the trading day begins, the letter C will appear directly to the right of the B period range. Unless, of course, the market opens above or below the current price. Then we will have a new high or low price. Think about it in the context that price is shown vertically and volume is shown horizontally. The initial balance represents the first 60 minutes of the pit session, or the visual representation of the B and C TPOs. You can see it circled on this chart. The initial balance will always be identified by the vertical red bar representing the price range of the B and C TPOs. We use the initial balance to determine an area of fair trade, or an initial range where both buyers and sellers are willing to participate. The initial balance is comprised only of the B and C TPOs. Any price extension above or below the initial balance is called range extension. Therefore, range extension can begin in the D TPO and continue for the rest of the trading session. You can see on the chart that you can have range extension above or below the initial balance in the same pit session. Range extension identifies in real time who is in control of the market. So any price extension above the initial balance means the buyers are in control, and any price extension below the initial balance means the sellers are in control. We use range extension in conjunction with the long-term trend in order to take the highest percentage trades possible. The point of control is the single most actively traded price of the entire pit session. It will always be the longest horizontal gray bar, like the one shown on this chart, and it will always have yellow letters. The high volume area, or HVA, is a range shown by a grouping of gray horizontal bars. They are concentrated areas of volume, and I will shade them on the chart like this one. HVAs, by definition, are levels of high participation, so they will act as magnets when price moves away from them. When the market is in an area of low participation, the market will often gravitate back to these established trading ranges. When price moves outside of an HVA, they will then also act as support and resistance. Often, if the price is trading above the HVA, it will now serve as support. And when the price is trading below the HVA, it now becomes resistance. HVAs are determined by trial and error. There is no exact science or mathematical formula for drawing them. I simply eyeball the largest grouping of horizontal gray bars. Tails are critical inflection points representing low volume. The price has been rejected at this level because of the lack of willing participants. A buying tail is a rejection of lower prices. Sellers don't want to participate at this level because they feel price is too cheap. A buying tail will always be at the bottom of a session's trading range. They must be at least 3 ticks long, as shown on the chart. The buying tail is only perceived support. A selling tail is rejection of higher prices. Buyers don't want to participate at this level because they feel price is too expensive. A selling tail will always be at the top of a trading session's range. They must be at least 3 ticks long, as shown on the chart. A poor high is the exact opposite of a selling tail. While a selling tail represents a rejection of higher prices, a poor high shows acceptance of higher prices. A poor high occurs when the market matches the single highest price of the trading session in a new TPO, as shown on this chart. A poor low is the exact opposite of a buying tail. While a buying tail represents a rejection of lower prices, a poor low shows acceptance of a lower price. A poor low occurs when the market matches the single lowest price of the trading session in a new TPO, as shown on this chart. A poor low equals acceptance of lower prices.
I realized early on in my trading career that the most successful traders are completely goal-oriented. But what exactly does that mean? And more important, how does that translate to helping you learn how to trade? First, I'll tell you what doesn't work: having vague or completely unrealistic goals. A newer trader saying that they immediately want to make tons of money can't be quantified. What does a lot of money mean? Is it $1,000, $10,000, $100,000? And over what time frame are we talking about? A week, a month, a year? It's tough to gauge if you can't measure it. On the flip side, what if you say that your goal is to make $5,000 a day when you're just starting out? Is that realistic? Probably not. However, if your goal is to make $100 a day trading the E-mini S&P, now that makes sense. A clear roadmap of daily, weekly, and monthly and long-term goals will help you stay on course. You should adopt this thinking even for your simulator or paper trading. Set a goal for yourself to make a certain number of simulated dollars each day before you ever trade any real money. The second important concept is visualization. I really believe visualization techniques can help you change your approach to trading and improve your life. I'm sure you've all heard the idea of a golfer seeing a shot in his mind or his imagination before he actually takes the shot. The same idea applies to trading. You can use visualization techniques to easily help your trading. Here's a good way that can help you use visualization techniques to improve your trading. Let's talk about the golfer seeing the shot in his mind again. Why does that work? How can seeing something in your mind or imagination help you to perform better? You may or may not know that many athletes and top performers use visualization techniques to improve their performance. This works for one very simple reason. As Dr. Maxwell Maltz says in the book Psycho-Cybernetics, your mind cannot tell the difference between a real experience and one that is vividly imagined. In other words, when you imagine something clearly and vividly, you kind of trick your mind into thinking you've been in these situations previously. So a golfer would imagine he's taking a shot and try and use as much vivid imagery as he could while he is taking the golf shot in his mind. Then when he actually hits the real golf shot, it's as if he practiced the shot many times before. Many athletes use the same idea to help them perform better, and I bet many of you have heard of this concept before. The great thing is visualization techniques work great for traders. We teach traders to practice their trades in their mind to help them gain experience. There are many exercises included in the Secrets to Emotion-Free Trading Manual that will help you visualize your trading success. Do these visualization exercises every day for as long as possible. While I recommend doing them 30 minutes a day, that can be difficult in the beginning. Try to strive for consistency by doing them at the same time every day. Relaxation is the key to visualization. For visualization techniques to work, you need to be relaxed. This is paramount. I also have specific techniques for relaxation in the written materials.